Hello everyone, this is Mariel Weiss with Remax Realty Group, and today we're going to talk about PMI. There really are a few aspects of financing a home that confuse people as much as PMI, which stands for Private Mortgage Insurance. It is an actual insurance that the mortgage company will require you to take out for the loan whenever there is less than a 20% down payment. This is because since typically a lower down payment could represent a higher risk to the mortgage company, this protects them in the case that you would default by not paying the loan. PMI is normally included in your monthly mortgage payment. However, there are programs that allow you to pay it up front or to finance it in instead. And the actual amount you pay will vary based on your total loan amount and the percentage of your down payment. So the higher your down payment is, between 0 and 20%, the lower your PMI rate will be. And then that rate is calculated against the loan amount to determine your PMI. You can avoid PMI altogether by putting down 20% or more, or like I said, paying it up front. Sometimes people also do piggyback mortgages, which is where you separate your total loan amount into two separate loans, one for, say, 80%, another one for 10, say you have the other 10% down. That's not so common anymore, especially in our market, but it is another alternative. Depending on the type of loan, PMI does not last forever. So if you have a conventional loan, you can contact your mortgage company and request them to remove the PMI when you've reached 20% equity in the home. So when you see you've paid your loan balance down to 80% of the purchase price or the refinance value, contact them. Now, if you've done improvements to the home and you feel that the home value has risen enough to where you may now have 20% equity, then you can ask them to remove it. Although in that instance, they typically will ask you to pay for an appraisal, which runs around $400 or $500, to prove that the value has risen. Now, it's a different story for FHA loans. Any FHA loan that was taken out after April 1st, 2013, that has less than 10% down, the PMI on those loans will stay for the lifetime of the loan. So the only way to get rid of it is to refinance out of it into a conventional loan, or to sell the house and move on to something else. Any loans started before April 1st, 2013, any FHA loans, I should say, started before that date, the PMI will automatically fall off when you reach 22% equity, or you can just stay on top of the numbers and contact the mortgage company and ask them to remove it when you hit 20% equity. Now, the good news is, I know a lot of times people are afraid of PMI or they don't like it, they, complain about it, but the good news is that for many people, it is tax deductible. So as long as you're within the income limits, which is $110,000 for a married couple and $55,000 for an individual currently, then you can write it off at the end of the year with your taxes, along with your real estate taxes and mortgage interest. The good thing about PMI is that it helps people who would otherwise not be able to purchase a home. It allows them to purchase a home because it removes the need for a huge amount of cash for a down payment. If you'd like to learn more about this topic or anything else, or to start the process of buying or selling a house or refinancing, let me know. I can put you in touch with all the right people. Thanks so much.